Hello, I'm Bernard Hickey from Interest.co.nz and welcome to an economic weather report. Today we've got inflation figures on producer prices, both inputs and outputs, and the numbers are a real shock. Producer price inflation frankly exploded in the June quarter. That was because of a big jump in wholesale electricity prices and of course the rise in petrol and diesel prices. Input inflation for the quarter, so in the June quarter from the March quarter, was up 5.6%. That growth rate is the highest since March 1980. And it was double economists' forecasts. The annual rate of growth in inputs inflation is now 11.8%, so double-digit inflation for the price of inputs for people running businesses. That annual rate is the highest since September 1985. You can see here from the second chart, output prices, so the prices businesses charge for the stuff they make, are rising very fast as well. Output inflation in the June quarter was 3.5%. That was the highest since June 1985. And the annual rate of 8.5% was the highest since September 1987. Remember, the GST was introduced on the 1st of October 1986. So just to put this into perspective, output inflation, the prices that businesses are charged for their own goods, that inflation rate is rising as fast as it did just after we introduced GST. Now, why are we seeing such big increases in input and output inflation? Largely it's because of wholesale electricity. We've seen a huge spike, as you can see here from this chart. Big spike in wholesale electricity prices, largely because of the drought. Those hydro lakes went to a very low level and spot prices rose very fast. Some businesses, particularly big businesses, buy a lot of electricity on the spot markets, unlike consumers in their homes who have more regular prices. So what's going to happen now? Well, we've seen already since the end of the June quarter that wholesale electricity prices have dropped because the rains have come. Although it's interestingly, in the Sth Island, we are seeing the hydro lakes still very low, between 20 and 35%. Snow everywhere, but no water in the lakes. No doubt that will melt and go into the lakes and prices will come back down again. But we're not out of the woods yet on electricity prices. Also the oil price. Now, there have been drops in the crude oil price over the last couple of months, from a high of nearly $150 a barrel down to about $115 a barrel now. But the problem for us is that the New Zealand dollar at the same time has been falling. So big cuts in the crude oil price don't necessarily translate through to falls in the price that we pay at the pump. And you can see here that there's been a slight dip, but not a big one. So what does this all mean for monetary policy and interest rates? Well, the Reserve Bank was expected to cut the official cash rate by 25 basis points, a quarter of a percentage point, every time it changed interest rates until the end of the year. So 3 times, September 11, October 23 and December 4. Most expected before these numbers, we would see continued cuts in the OCR. Well, these numbers really have put the cat amongst the pigeons. Will the Reserve Bank be able to cut interest rates again and to do it fast? We'll see. Some of the commentary coming out is that they won't be able to. I'm Bernard Hickey. That was an economic weather report for Interest.co.nz.